Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the second installment of our mini-series around the H2 outlook. Yesterday I spoke to Rajat, who shared his insights into the economic outlook. Today I want to focus on the outlook for bond markets. To do this, I have asked Abhilash Narayan to talk about the opportunities he believes are available to investors today. Amongst other things, we will discuss why we have increased our allocation to bonds, why developed market high-yield bonds make sense despite the increased risk of a recession, and how China's different stage of the cycle feeds into our view on Asian bonds. Before we start, I wanted to flag that we're having a live webinar on Monday, the 4th of July. So this event includes a fireside chat between myself and Professor Raghuram Rajan, who's the former IMF chief economist and former Reserve Bank of India governor, where we will discuss key financial imbalances we should be worried about, the regulatory outlook for cryptocurrencies, and the future for India and China. You'll also hear from Standard Chartered's CIO office on how you might position your portfolios given the opportunities and risks facing investors going into the second half of the year. If you're interested in registering for the event, you can do so at www.sc.com/GMO, which stands for Global Market Outlook, or just click the link in the description of the podcast. With that, let's get starting about the current bond market environment. So, Abhilash, I guess one of the biggest changes of our asset allocation calls is the increased allocation to bonds. So, can you explain your thinking here and why adding bond exposure makes sense today?
Hi, Steve. Thanks. Great to join you. So, one of the biggest concerns for investors today is the higher risk of a U.S. recession. And while clearly there is a lot of debate going on about the extent to which equities have priced in a recessionary outlook, what is clearer to us is that, in our view, the bond yields are looking increasingly attractive. So, if you think about U.S. government bond yields, for instance, we believe that we are past the surge phase that usually occurs in early stages of a rise in yield. Now, if you look at it from a scenario perspective, in a scenario where a recession is avoided, bond returns are likely to be equal to approximately the yield on offer today. And if a recession does occur, then the return generated by the yield is likely to be bolstered by capital gains as bond prices rise when yields fall and when central bank cut rate. So in either of the scenarios, the risk reward for bonds has improved relative to equities in our view, and that has led us to upgrade developed market investment grade bonds to a core holding.
Okay, so can you give us a sense of where you expect US government bond yields to peak, and what does this mean for corporate bonds in the investment grade space?
Sure. So if we just dive a bit more into the scenarios that I mentioned, right, and let's look at three potential scenarios that could potentially take place. So in the first scenario, let's assume that the Fed hikes rates as it has guided, and we manage to avoid a recession in the US. If that happens, we believe that markets have priced in most of the rate hikes, and yields are likely to trade in a range-bound manner around 3.25%, which is not far from current levels. Now, in the second scenario, if the tighter financial conditions in US lead to an economic slowdown, the Fed may end up hiking less than currently expected, and that could lead to lower yields and higher bond prices over the next 12 months. Now, in the third scenario, should the Fed choose to hike rates even more aggressively to curb inflation, then clearly the recession risk will climb rapidly. So under such a scenario, yields could temporarily move towards 4% but as a specter of recession looms on the horizon, we think markets will start to price in aggressive rate cuts and yields could move below 3.25% on a 12-month horizon. And that means that government bonds could outperform other asset classes. So in all the three scenarios, we think that the outcome is largely favorable for US government bond yields. As far as investment-grade corporate bonds are concerned, we think that the risk reward is a little less attractive. So credit spreads have increased a bit since start of the year, but we still think that they have priced in a fairly low degree of recession risk compared to other areas in bonds. Hence, we think that the risk reward for US investment-grade corporate bonds is less attractive as compared to the government bonds or even high-yield bonds.
Okay, so that's a good segue into where I wanted to go next. So let's look at some of your preferences within bonds. So let's start with developed market high yield. I was talking to Rajat yesterday, and he flagged there was a rising risk of a recession, right? So, and you alluded to that risk in your scenarios. Given high yield or junk bonds have a lower credit quality and are associated with increased default risks, how do you square the circle between recession risks and an overweight positioning in high yield bonds?
Clearly, the recession risk in US is elevated right now. However, when it comes to developed market high yield bonds, we believe that corporate fundamentals are starting from a relatively strong base. Now, if you look at the overall leverage ratio for US high yield bond issuers, that has declined quite sharply over the past year. And their interest coverage ratio right now is higher than what we saw prior to the pandemic. Now, from a technical perspective, US high yield bond issuance is the lowest we've seen in the past decade, and it's around 75% lower than what we saw last year. So, when we combine the lack of issuance with the recent deleveraging for corporate issuers, it's a fairly positive credit trend in our opinion. Now, from a valuation perspective, credit spreads today are fairly higher than what they were at start of the year, or even before the start of the two previous recessions. And by our estimates, they are pricing in around 5% default rate over the next 12 months. So when we consider the fact that US high yield bonds are offering yield of close to 9%, and the fact that they have priced in a fairly large amount of downside risk, especially if the next recession is a shallow one, we think the overall risk reward for developed market high yield bonds stacks up as attractive relative to other areas within the bond market.
Okay, so let's move to Asia. So I was also talking to Rajat about the view that China is at a different stage of the economic cycle. So I know you prefer Asian US dollar bonds as well. How important is this economic cycle to that view?
Well, that's one of the key drivers why we like Asian dollar bonds. So, if I was to distill down the reasons why we like Asian dollar bonds, I would highlight five factors. First, as you mentioned, China is in a different stage of the economic cycle and is likely to ease monetary and fiscal policy further. Now, while we would have liked a faster pace of easing in China, the backdrop is still fairly more supportive in China as compared to US and Europe, which face potential for growth slowdown due to tighter policies. So overall, the macroeconomic backdrop in China is more favorable for Asian dollar bonds. Now, secondly, Asian dollar bonds have a fairly high aggregate credit quality. So around 83% of the bonds in the Asian dollar bond market are investment grade rated, and in fact, Chinese high yield bonds, which are under stress, account for only 7.5% of the market. So overall, it's fairly good credit quality. Now, thirdly, the supply for Asian dollar bonds, especially in the high yield segment, has declined sharply. Now, when we combine this with the fact that the dollar bonds in Asia are offering higher yields in most cases than onshore Chinese bonds, we could start to see incremental demand flowing through for Asian dollar bonds once the sentiment stabilizes. Fourth, Asian dollar bonds have outperformed global bonds year to date. And one of the key reasons for that is that they had priced in a fairly elevated amount of default risk in past. So despite the fact that we have seen, a few defaults happen in Asia, they still managed to outperform the global bonds. And, we continue to believe that going forward as well, current valuations have priced in a lot of bad news. And lastly, Asian dollar bonds has been an asset class which has historically been less volatile than most of the other bond markets. And this has played out this year as well. So Asian dollar bonds have delivered a superior risk-adjusted return with lower volatility being there. So when we combine all these factors there, we think that the risk reward for Asian dollar bonds looks fairly attractive.
Okay, thanks. Let's stay sort of in the emerging market space. So we've previously had a preferred view on US dollar government bonds, but what's your latest thinking on EM bonds generally?
So we have downgraded emerging market dollar government bonds to a core holding, and we also see emerging market local currency bonds as a core holding for the next 12 months. Now, if you look at the headline yield offered by emerging market, both dollar as well as local currency bonds, it's fairly attractive. But looking ahead, we think that the return prospects are going to be mixed given the divergence between commodity exporters and importers. So when we think about EM, it's an aggregation of a number of different countries, right? And while commodity exporters are likely to benefit from the surge in oil prices above $100 per barrel, we think that the negative impact on the importers could potentially outweigh these benefits to the exporters. In addition, we see higher food inflation as a potential point of stress, given that on an average, food-related components account for about one-third of EM CPI baskets, which means that EM central banks may be forced to continue hiking rates despite headwinds to economic growth. So net, we believe that there is a realistic risk of an uptick in EM default rates, and hence we would rather take exposure to emerging markets through Asia, which is relatively more defensive and has much better macroeconomic backdrop ahead.
Thanks, Abhilash, and thank you for sharing your insights. And thank you, listener, for joining us today. So tomorrow I will be talking to Fukian Yap to talk about the outlook for equity markets from both a global, regional, and also a sector perspective. Just as a reminder, if you'd like to sign up for our H2 Global Market Outlook webinar, please click the link in the description. In the meantime, I look forward to talking to you again tomorrow, and take care and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.